All right, let's get right into it. Gold has been consolidating, just sitting there near these all-time highs. And the big question on everyone's mind is, where does it go from here?
So many people are looking at this chart and thinking a crash has to be coming, right? I mean, it feels like we're in the eye of a hurricane, just kind of waiting for that other shoe to drop. But what if that's the completely wrong way to be looking at this?
Because according to analyst Martin Armstrong, founder of Armstrong Economics, a crash is it's not in the cards. And his reasoning, it goes way beyond the usual stuff we hear about, inflation and interest rates. So in this explainer, let's unpack what he's seeing.
To really understand why gold is holding its ground so stubbornly, Armstrong says we've got to look past the normal economic indicators we're all obsessed with. And here's the crucial point he makes. The real strength, the very backbone of gold's current price, is this global sense of instability and, frankly, fear of what's just around the corner. And as we're about to see, this is not a new thing at all.
So this look at this slide. It's a classic example from history. Armstrong points back to the late 70s. You can see gold was already on a tear, going from $100 to $400 over a few years. But then, bam, the geopolitical shock of Russia invading Afghanistan in December '79, that was the rocket fuel. Gold went absolutely parabolic, more than doubling to its peak of $875 just 1 month later. History is pretty clear on this. Fear moves gold.
Okay, so what is feeding all this geopolitical fear today? Well, Armstrong argues it's not just one thing. It's this global convergence of crises, and they're all rooted in a much, much deeper problem: sovereign debt.
I mean, this visual here really captures the sheer scale of the problem. Armstrong describes it as a world where old resentments are just boiling over everywhere, all at the same time. This isn't just one regional conflict anymore. It's a massive, widespread global destabilization.
And all of this is happening right alongside something that's even more systemic: a global sovereign debt crisis. He argues that the very bedrock of our financial system, confidence in government debt, well, that bedrock is starting to crack. Now, this is where the analysis takes a really dark turn. Armstrong suggests that for some governments, especially in Europe, war isn't just a risk they're trying to avoid. It might actually be a potential escape valve.
He lays out this chilling domino effect. See, when confidence in a country's debt starts to collapse, it doesn't just hit the government. It threatens the banks, whose reserves are stuffed with that debt. And then it jeopardizes the pension funds that are legally required to hold it. So, when you're facing a public that's about to come at you with pitchforks, the argument goes, what do? You create an external enemy to distract everyone from the collapse happening at home.
He really anchors this entire argument in that simple, stark quote, often attributed to Margaret Thatcher. The basic idea is that these systems have finally reached their mathematical limit, and now leaders are desperately looking for any way out. Okay, so with all this chaos, there's a really counterintuitive twist. While so many people are predicting the demise of the US dollar, Armstrong actually argues it's probably going to be the last currency left standing. And the key difference all comes down to the debt structure. See, in Europe, if let's say French debt has a crisis, it immediately puts every single bank holding those bonds at risk. It could create a continent-wide contagion. But in the US, bank reserves are in federal debt. So if California goes bust, it doesn't automatically trigger that same kind of systemic banking crisis.
And this brings us right back to gold. So why are central banks in countries like China buying it up like there's no tomorrow? Armstrong says they're not being bullish on gold. No, they're treating it as a neutral asset. It's a place to park wealth that isn't tied to any one country's political whims or debt. It's kind of like they're saying, hey, it's a coin flip who survives all this, so we're just going to take some of our chips off the table. The moment that really drove this point home for the rest of the world was when Russia got cut off from the SWIFT system. That sent up a massive red flag. It showed everyone that holding U.S. debt could suddenly become a huge liability if your country ever falls out of favor with U.S. policy. So what did they do? Nations started dumping U.S. debt and looking for a neutral alternative. Okay, so if all this geopolitical fear is providing the floor for gold's price, what's the big catalyst that Armstrong believes will prevent any kind of real crash from happening?
Well, his computer models are forecasting a major escalation. He says the real turbulence, it really starts to pick up again after January of 2025.
And that right there is the core of his thesis. The market is not pricing in peace. It's pricing in the anticipation of more conflict. And that expectation provides a firm bid under the price of gold, which makes a significant crash, say back down to $2,000 an ounce, extremely unlikely in his view. So what this explainer has laid out is a forecast of escalating global tension, a world where gold acts less like an investment and more like an insurance policy. It's a pretty sobering analysis, and you have to admit, if it holds true, it forces all of us to really reconsider what safety and neutrality actually mean in a world that feels more and more unstable.